Hi guys. Well, we're going to start on section 2 of chapter 21. We've just the first installment of this video series in this chapter dealt with a static budgets and converting a static budget, which is a budget at one level of activity, just converting it to a flexible budget, which is really just expanding it to know what the various revenues and costs should be at various levels. Fixed costs, of course, won't change. They're the same across all levels in a flexible budget. But as the production levels go up, variable costs are expected to go up as well as the revenues are expected to go up as well. So that's what we talked about. So when we want to compare the results, the actual results of operations to the budget, we want to make sure we're comparing it to the correct budget, what the numbers should be at the correct level of activity. Now this next section deals with standard costs and also evaluating production. We usually spend 2 or 3, I think, days on this, and we go over it several times, which enhances understanding. But I guess we're fortunate here is that we can go over it once, and you can watch and rewatch this video to see how this is done. But anyway, here's what we're doing in this section. What we want to know is at the end of a month, a production month, or at the end of a quarter, we are going to track what it cost us to produce however many items we produced, and we want to compare that to what it should have cost to produce that number of items. So the very best place to start is with the standard costs. Now, what a standard cost is just the costs that should have been incurred to produce a single product. So if I'm making teddy bears, I might have a budget for producing 10,000 of them, but where does that budget come from? Well, some engineers or people who know what costs should be, they've determined what it should cost to make one teddy bear. And that's what a standard cost is. To make one teddy bear under, maybe not under ideal conditions, but under, let's see, what do they say? Well, here it is. It's what it should cost to make a single product, a single teddy bear under, using a practical standard. We don't use an ideal standard. An ideal standard assumes that there will be nothing will go wrong. No machines will break down. No employees will be late. No supplies will be late or on back order. Well, things happen. So what we're going to do is we're going to build in a little bit of those kinds of things, and we just want to know what should it cost to make one unit of my product under practical standards. Now, in this class, that's not our job. We're not engineers. Somebody's going to tell us what the standard is, and based on that standard, then we as accountants, we can measure what it cost to make the certain number of products this period of time and compare it to what it should have cost. And that's what this whole section's about, is just taking the standard to make one item and blowing it up and using that to determine our level. So here's what I'm going to do. I actually developed this template for working with the standard costs and determining the various variances that we're going to discover here. Like every other chapter, the key to this is organizing the information, and I think that this organizes it pretty well, at least in our initial exploration through this area. It's good to be able to see it all in one place. So now what it does is it starts with the standard cost, and like I said, it's not my job. I'm not an engineer, and I can't as an accountant, I just track costs and I report information. Okay, sorry about that. A client called and had to take that phone call. So I think where we left off is we were talking about this template, and that before the year even starts, the engineers are going to tell us what it should cost, or the people that are really maybe the owners of the company or whoever really knows is going to tell us what it should cost to make one item of whatever it is we're making. And I don't know what example to use here. We're going to say that we're making a product. We're going to make a lot of them, but we want to know what the standard cost should be. What should it cost in materials, labor, and manufacturing overhead or factory overhead? What should it cost for our 3 product costs to make one item? So whoever it is that is doing this determination, they're going to look at materials. And the cost of the materials going into one item is a function of, well, how much are we going to use and what does that material cost? So, and in all of our problems, they have to give us the standard cost. So I'm going to say that in our example here, that one product takes 12 ounces of direct materials that cost $5 an ounce. So therefore, each product should be taking $60 of direct materials. Like I said, the book, the text, the problems have to tell us what the standard costs are. So that's what I'm just putting in here, that one product, just to make one of these things, whatever it is, should take 12 ounces of direct materials, and that direct material costs $5 an ounce. So there should be $60 of materials in each unit of product we produce. Direct labor. How much should the direct labor cost be for producing one unit? Well, that's a function of how much time is it going to take, and how much do we pay per hour? Well, in this one, I'm just saying that they told us that each one should take 6 hours, and we pay $15 per hour. So that comes out to $90. Every unit we produce should have $90 of labor in it. So far, in producing one of these units, I should be burning through $60 of material, $90 of labor. The third product cost, the manufacturing overhead, that's the one that's broken up into variable and fixed costs. Variable is a function of, of course, because the variable manufacturing overhead, variable factory overhead, by definition, it stays constant per hour, but as I get busier, it's going to increase in total. So what I want to know is, well, we've measured what my variable overhead is, and they've determined that the variable factory overhead is $3 per direct labor hour. $3 per direct labor hour. And recall that factory overhead is many times tied to labor. So the powers to be have said, well, variable overhead, it varies with activity. We're going to define activity by labor, and we have found that variable overhead costs $3 for every direct labor hour incurred. So how much direct or how much variable manufacturing overhead should there be in one unit of product? Well, if it's $3 per hour and each unit takes 6 hours, so that's what this arrow means, 6 hours, every unit then should have $18 of variable overhead in it. We should incur $18 of variable overhead. And how much fixed overhead should we have in this thing? How much fixed? Well, fixed overhead, recall, remains constant in total, and it varies as per unit as production levels go up and down. So I want to know, what is my total fixed manufacturing overhead? What is my total rent, total insurance, that kind of thing? So we work it out and look it up. Whoever it is says, well, we're budgeted to have $120,000 of fixed overhead for this month. We'll just say it's for a month. $120,000 of fixed overhead. Well, how much is that per unit? Well, spreading that $120,000 per unit, I need to know how many units do I normally make? How many so That's where I need this normal capacity right here. In order to determine how many units to spread this 120,000 over, I need to just say, well, how many units do we normally make? So I'm going to say in a normal month, we usually make 10,000 units. 10,000 units. And what would then be the normal number of direct labor hours that I would incur to make 10,000 units? Well, each product, each one takes 6 hours. So to make 10,000 units would take 60,000 hours. This is what's known as my normal capacity. On a normal day or normal month, I would normally make 10,000 units, and that would normally take 60,000 hours. That's how I define my normal level of activity, either in units or in hours. Well, how does that come out to be then? What does that come out to be? For fixed overhead, what is the rate? Then what is the fixed overhead rate per hour? Well, if I have $120,000 and I want to know what is that per hour, divide 120,000 by 60,000 direct labor hours. That's $2 per hour. And if every unit normally has 6 hours, that comes out to $12 of fixed overhead in every unit. Just want to point out here that, let's see, where's my green? There's my green. That the total amount of overhead spread over the total number of direct labor hours gives me the direct labor, or the fixed overhead rate per hour. Likewise, the total factory overhead spread over my normal number of units gives me my, my cost per unit. Spreading 120,000 over 10,000 units is $12 per unit. So this works. We've just broken this into hours. We've broken it into number of net per amount per unit as well. So based on that, every unit now should cost $30 in overhead, $18 in variable overhead, which is running at $3 per direct labor hour times the number of direct labor hours in each unit, and plus the fixed overhead per unit, which is the total fixed overhead divided by the number of units. So therefore, the standard cost for making 1 unit of product is $180. Just totaled them up. This is something you're probably going to have to think about and kind of work through a little bit, and do take the time to work it out. But the cost, the standard cost to make 1 unit, and that's kind of redundant because the standard cost is for 1 unit, is $180. I should be using, the materials should cost $60, which is a function of how much material I'm going to use times the cost of the material. Labor is a function of the amount of labor it's going to take times my cost of labor. And then the overhead is a function of what my variable overhead is running per hour, and my fixed overhead spread over the number of units I'm going to be making. So it costs $180. Should cost $180. So this is my standard cost, and this is developed before the year even starts. We would laminate this and pass it out and put it up on the wall so everybody knows this is what it should cost. Now the year begins. Maybe the first month goes by and it's January. Now this is actual production. So for January, we actually produced 10,500 units. Oh, a few more than we normally do. A few more than that. But we produced 10,500, and records show, now we check our accounting records to see what did we buy in materials, what did we pay for in labor, and what was my actual manufacturing overhead costs. So that's what this is actual. This comes right from the accounting records. This is what I actually paid. This is what it actually cost to make these 10,500 units. I'm going to say that we actually used 129,000 ounces of material. It cost $4.90 per ounce. Got a little deal on it. Remember, it's supposed to cost $5 an ounce, but I found it for $4.90. So total material costs for these 10,500 units were $632,100. Total material cost. Labor. I'm going to pull the labor records, and I show that we incurred 64,000 hours. We're a pretty big factory. 64,000 hours, and we actually paid $15.50 per hour. So my labor cost, my total labor cost was $992,000. And then just based on the bills that I paid for factory overhead, rent, insurance, repairs, every other cost of the factory, they added up to $320,000. So the total cost to make these 10,500 units, it actually cost $1,944,000. How'd we do? Well, we need to know, what should it have cost? Here's the budget. What should it have cost to make those 10,500 units? This is what it did cost, but what should it have cost? Well, we can determine what it should have cost, because this is what it should have cost to make one. So based on this, I can determine what it should have cost to make 10,500. Let's start with materials. How much materials should I have used? How many ounces of materials should I have used to make 10,500 units? Well, each unit should have taken 12 ounces. So how many ounces should I have used to make 10,500 units? That's 10,500 times 12 ounces per unit. We should have used 126,000 ounces. 10,500 at $12 ounces per unit. And what should it have cost? It should have cost $5. So direct materials should have been 126 times 5. Should have cost $630,000. And a way to check that is, well, that's 10,500 units at $60 a piece. $630,000. Labor, we're going to do labor the exact same way. It should have taken 6 hours to make one unit. How many hours should I have expected to make 10,500? 10,500 times 6 should have taken 63,000 hours. That was the budget. That's the budget for producing 10,500 units. We're budgeted for 63,000 hours, 6 hours per unit. The budgeted cost should have paid $15 an hour, so I should have burned 63,000 hours at $15 an hour. That's $945,000. And how much should overhead have been? Don't break it down between variable and fixed. Just use this one number. Overhead should have cost $30 per unit. I made 10,500. What should my total overhead have been? 10,500 times 30. $315,000. So my budget for making 10,500 units, it should have cost $630,000 plus $945,000 plus $315,000. Should have cost $1,890,000. A way to check that is just, well, 10,500 times 180. To make 10,500, it should have cost $180 a piece, $1,890,000, made up of direct materials, direct labor, and overhead. So all we did was, we actually went into the accounting records, found out how much material we used and what it actually cost, how much labor we actually used, what labor cost and what the total was, what the bills actually added up to for factory overhead to get our total actual cost, and then we used the standard to determine what my budget for that level of activity was. Using the quantity times the standard price, quantity. So now, here's what it actually cost. Here's what it did cost. How'd we do? Let's start at the bottom. Looks like my actual costs were more than my budget. Looks like I'm, what, $54,000, cost $54,000 more than budget. Is that favorable or unfavorable? That's unfavorable. Cost $54,000 more than it should have. Wow, I wonder which one of these items actually caused that. Well, we're going to compare each one of the items and find out how we did as well. Let's start with materials. Should have cost $630,000, actually cost $632,100. There's a variance there. This is a variance. $2,100 variance, favorable or unfavorable? Actual costs were more than budget. That's unfavorable. Labor cost $992,000. Should have cost $945,000. Looks like we're over budget on labor by $47,000. That's also unfavorable. And overhead, $5,000 more than it should have cost, so that's $5,000 unfavorable. Just so happens in this example they were all unfavorable. It could be anything. They could all have been favorable, or it could have been favorable, unfavorable, favorable, whatever. But now let's just make sure it adds down. Do these three unfavorables total to this? And 47, that's 53. Whoops, they don't. And it's because, oops, this is a 1. Sorry. That's a 1, which makes this a 1. So these actually add down to $1,944,100, which makes the variance 54.1. Now they add down. That's the beauty of accounting, is that we have these checks and cross checks that we can do this with. So we were $54,100 over budget because materials were slightly over budget, just $2,100. Labor looks like that's the culprit, $47,000 over budget, and then overhead was $5,000 over budget. So we want to know which one of the three product costs caused the variance, so we may be able to take corrective action. But we're not quite done yet. We know what the variance was for each one of the product costs, material, labor, and overhead. But now I want to do what I call subvariances. I want to break these variances up into what I call subvariances, and we do that by doing this. Now let's take these one at a time. Of course, we just take them one at a time. Let's start with materials. We were $2,100 over budget. Now there's only two reasons why we would be off the budget. There's only two. Because there's only two factors that go into determining the cost: quantity used and the price I paid for the quantity. So I was actually over budget, so I either used more than I should have, or what I did use cost more than it should have, or a combination of the two. So I want to know this $2,100 unfavorable variance. How much of it was because of usage, because of quantity used, and how much of it was because of the price I paid for the actual quantity I used. So that's why we break these up into what's called a quantity variance and a price variance. Okay, now really what the quantity variance is, it's a function of these two right here. It's a function of I actually used 29,000 ounces and I should have used 26,000 ounces. We're just concentrating on quantity. So to calculate the quantity variance, the book does it kind of a hard way, but this is an easier way to do it. The quantity variance is a function of, it's the standard quantity minus the actual quantity just the difference in quantity. And you can turn it around the other way if you want, actual quantity minus standard quantity. What was the difference in quantity? And what was my difference in quantity? It was 3,000 ounces I was off. And now we're going to convert that into a price. How much should that 3,000 ounces that I overused, how much should it have cost? We're going to use the standard price. Don't use the actual price. We want to use the standard price because this is already a broken number. We're going to capture that other 10 cents in the next variance. I'm just determining how much was I off on quantity times what it should have cost, $5. So that right there translates into $15,000. And is that favorable or unfavorable? Did I use more than I should have, or did I use less than I should have? I used more than I should have, so that makes the quantity variance unfavorable. And there's the formula. Just how much was my quantity off, and then convert it to dollars by multiplying it times the standard price. Now, price variance. Price variance. The price variance is a function of how much I actually paid for it compared to what I should have paid for it. So notice this, this is creating a price variance. Now, if this was $5 and this was $5, there would have been no price variance. But there is a difference between my totals based on the price. The formula is actual price minus standard price, or standard price minus actual price. How much was my price per ounce off? It was off 10 cents. And I actually saved 10 cents per ounce. And on how many ounces did I save that? Every ounce I used. So it's the difference in the standard price versus what my actual price was times the actual quantity. 10 cents times the 129,000 ounces I actually used comes out to be $12,900. I saved 10 cents on all 129,000 ounces I used, so that variance is 12,900. Is it favorable or unfavorable? It's favorable because I saved 10 cents. Do these two net to that variance? And the answer is yes. We had a $15,000 unfavorable variance because I used too much, but it was mostly offset by a $12,900 favorable price variance. And if we net this negative with this positive, it comes out to a net negative of $2,100. Now, the reason I want to break out these variances is because who do I talk to about these variances? Well, I would go talk to probably the production guy, the production foreman. He's the one that's out there. They're the ones that are controlling how much is being used. We might go talk to him. Why did you use, because of usage, because of quantity, you used 3,000 more ounces than you should have. Maybe that's something that's correctable. And I may want to go talk to purchasing. The production guy is probably not the one that buys it. We may want to go talk to purchasing and say, hey, how'd you save 10 cents an ounce? Keep it up. Keep going. So that's how I would determine the reason for my total variance. Because I used more or less than I should have. In this case, I used more. And I paid more or less than I was supposed to. In this case, I paid less. We're going to do the exact same thing. It is the exact same thing with labor. Although it's not called quantity, it's called efficiency variance. And labor doesn't have a price, it has a rate. Yeah, the book actually uses these terms. There's an efficiency variance, which is a function of the quantity of hours used. And there's a rate variance, which is a function of the amount I paid per hour. The formulas are exactly the same. So I'm going to put quantity or efficiency and price or rate. Let's calculate this out. Where should I put this? How about if I drop this right over here. Efficiency. We'll calculate efficiency right over here. And now efficiency is a function of actual quantity minus standard quantity. It's the efficiency. How efficient were we? How many hours did it take? How many hours should it have taken? How much was my hours off? They were off 1,000 hours. I used 1,000 hours more than I should have, and I multiply that times the standard rate. And what's the standard rate? What should that 1,000 hours cost? It should have cost $15. So that extra 1,000 hours, that extra 1,000 hours that I used should have cost me at the normal rate $15,000. Is that favorable or unfavorable? Did I use more or did I use less? Well, I used more than it should have based on the standard, so this is unfavorable. And the rate variance is the same formula we saw up here. It's the difference in what I did pay and what I should have paid. It's actual price or actual rate minus standard rate, which is, looks like I'm 50 cents. I paid 50 cents an hour more than I should have. 50 cents an hour more than I should have. And on how many hours did I actually pay that additional 50 cents? All 64,000 times the actual quantity. All 64,000. Well, that translates into a $32,000 $32,000 variance. And because I paid more than I should have, that's unfavorable. The formulas are exactly the same. Efficiency or quantity is the difference in quantity times the standard price. And price or rate variance is the difference in price times the actual quantity used. Notice, do these two unfavorables net to this? And the answer is yes. Why is it important to break this variance up into the portion attributable to efficiency or to usage and to rate? Well, again, I'd probably talk to the production guy, the same guy I'd talk to about using too much material. I'd probably talk to about using too much labor. And then I might go talk to HR, human resources, about why are we paying $15.50 an hour? And they may have a valid excuse for it. It's just, well, rates are going up. Maybe the law changed, minimum wage went up, something. But it's important to investigate these things. We investigate both favorable and unfavorable variances, just to see where we are. Finally, this one's a little bit of a different animal here. A little different animal. What we're going to do here is we're going to say, okay, we have a $5,000 unfavorable variance in overhead because my actual overhead cost $5,000 more than the budget for overhead would be based on the standard cost, 10,500 units times $30 per unit. Why did it cost $5,000 more? Well, this variance can be broken up into what's called a controllable or spending variance. Yeah, the text calls it a controllable variance, and because of a volume variance. Because of a volume variance. I'm going to do the easy one first. We're going to do volume variance. And this is really very, very straightforward. Let's see here. I'm going to do this. I want this space here to do our computation, so I'm just going to kind of hide this and throw this on here, throw some tape on here, so we can use this space to do the variances. So now, the volume variance is really very simple. It just says this, and keep it simple. Don't let it get complex. All the volume variances has to do completely with fixed factory overhead. Now notice what we said. We said that we planned to spread our fixed overhead here, $120,000. If we attained normal volume, 10,000 units produced, then they would have cost $12 per unit. But did I actually attain the normal volume? The answer is no. I actually made 500 more units than I normally do. So that creates a variance. That means that I got to spread this 120,000 over a larger volume. Now the volume variance, do it this way, put in the formula here. The volume variance is simply a function of the, I'm going to put actual volume minus the normal volume. Let's start with that. Actual volume was 10,500 units. That's what I actually produced. The normal volume is 10,000, which was established way back when we established the standards. So I was actually produced 500 more units than I had anticipated doing. So that means that I got to charge 500 more units $12. At $12 per unit, that comes out to $6,000. And that's the volume variance. Is it favorable or unfavorable? Well, it's good to make more units. We were busier than we thought, so I got to spread that fixed overhead over a greater number of units. So that is a favorable variance. If I produce less, suppose I only made 9,000 units. Well, I was 1,000 units short, so that 1,000 units at $12 per unit would be $12,000. Unfavorable. So that's all the volume variances. Difference in volume times the amount amount of fixed overhead I was charging. Notice it has nothing to do with materials, labor, or variable overhead. That's the volume variance. Now, what's the controllable variance? The controllable variance, which is, and I don't know if it means, I don't know if that's a good term for this. Controllable means, oh, I can control this. But really what this variance is caused simply because things cost more or less than I thought they would. This variance, the volume variance, has nothing to do with what things cost. It's strictly based on just, did I overproduce or underproduce? That's all it is. Has nothing to do with prices. Controllable variance is what we're talking about for prices. So what I want to know is, the controllable variance is, we know what it actually cost. Actual overhead was $320,000. But based on the actual level that I attained, based on that actual level, what would I really expect? What would my budget, and this is what overhead would appear on the flexible budget. If I had a flexible budget that showed me what overhead should be at 10,000, 10,500, 11,000, 11,500, and so on, I want to know if at that budget, at the level of 10,500 units, what would I expect my variable overhead to be, and what would I expect my fixed overhead to be? Well, let's do this. Let's say, okay, I am going to take my variable overhead. Now, how much is variable overhead? What did we determine it should be? It should be $18 a unit. That's what we determined. It costs $3 an hour for 6 hours per unit, so I would really expect my variable overhead to cost $18 for every unit I produced. I produced 10,500. So I would expect my variable overhead to be $189,000. That is simply the variable overhead per unit times the number of units. Hey, how about if I made zero units this month? I would expect variable overhead to be zero. It's variable. If I made 20,000 units, I would expect it to be 20,000 times 18. It would have been 360,000. That's what I really would expect it to be. Fixed overhead. What would I expect my fixed overhead to be? Well, it's fixed. Regardless of how many units I make, I would have expected it to be 120,000. Remember, fixed costs on a flexible budget are the same at every level because they're fixed. So I would have expected to make 10,500 units. I would have expected my overhead to have been $18 a piece for variable plus the 120,000. That is $309,000. That's what I would have expected overhead to be. It was actually $320,000. That's an $11,000 difference. So my controllable variance, my controllable or spending overhead variance was 11,000. Favorable or unfavorable? Well, actual was more than what I would have expected, so this is unfavorable. And as a check, do these net to that? Yeah, an $11,000 unfavorable controllable variance simply due to prices, almost half offset, or a little bit more than half offset by a volume variance of 6,000 gives me a net $5,000 variance. Add and subtract these down. What do you think it comes out to? Well, it comes out to that. All we did was we broke these numbers into subvariances. So now I've got the entire picture of what took place with this production. I know what it should cost to make 1 unit of product at a normal level of activity. When I do produce a certain level, I actually get into the accounting records, find out what materials were cost, what labor cost, and what the overhead cost. I can use these standards times the number of units produced to come up with the budget. Then I can find out what my variance is for materials, labor, and overhead. And then I can break up the material variance into quantity because of quantity times the standard price, and because of the difference in cost times the actual number used. Exact same computations for labor. And then overhead, I can break it up into how much was my variance due to volume difference and how much was due to the controllable difference, which is prices, strictly prices. I'm going to jump into the text real quick and see what they have to say. Now again, setting standards, we set them at a practical standard of some kind for materials, labor, and overhead. Here's a standard that they came up with for this particular product. Should take a kilogram at $25 a kilogram, so direct materials should cost $25. Labor, each unit should take 2 hours at $20 per hour, so that should cost $40. And then overhead is 2 hours, $10 per hour. That's the overhead rate, both variable and fixed. So 1 unit should cost $85. I just wanted to point out that when they're calculating the total variance, they're doing it the same way I did. They're taking the actual quantity used times the actual price to get the actual cost, and they calculate the standard quantity times the standard price to get the budgeted cost. That's the total variance. But then when they break it down, they break down that total cost variance into price and quantity. Now recall that I said that the quantity variance was the difference between the actual quantity and the standard quantity times the standard price. Now they do it here. This isn't quite as easy to see, but notice they did it the exact same thing. The only difference between these two is they took the actual quantity minus the standard quantity and multiplied them both times the standard price. And we don't use the actual price here because that's a broken number. Difference in quantity times the standard price, and the price variance is the difference in price. And notice the only difference between these two is the price, actual price per unit times the standard price per unit, times the actual quantity. So mine is kind of a shortcut and a little easier to understand, I think. They do the same thing for the variance. They go through this the same kind of thing here, where they broke it down. We could have arrived at this a little bit different. We could have said, well, I won't. That'll probably be confusing. But they do it the same way. I just do it a little bit of a shortcut. Why we break it up into those variances. Labor variances are known as rate instead of price, and efficiency instead of quantity, but they work exactly the same way. Exactly the same way. They go on to talk about overhead variances and the flexible overhead budgets. Here they're actually just calculating out what the the variable and the fixed overhead should be at a particular level, especially at the level we attained. We need this for the controllable variance. And so we take our total overhead variance and we break it into the volume variance and the controllable variance. Not too much. We're not going to get, even on the exam, I'm not going to get into these variances, into the overhead variances. We're going to stick with because they're just confusing, and at best, gosh, when I can go over it with you, half a dozen times, then I might be able to hold you to the understanding there. Just recognize that the overhead variance can be broken into two variances, but concentrate on the material and labor variances. And I believe, yeah, that's basically the end of the chapter dealing with that. So what I'll do is I will load this blank template onto Canvas. So if you want to use it to work through maybe some of your homework problems or something, I just want to make sure that you have it available to you. I'll change this so it ties into the book, and but hopefully that will help. You may need to go through this a couple times. Watch this video a couple times just to see where the numbers are coming from, and how these are actually being computed. And but like I said, just stick with me. Do the best job you can. We're making all kinds of trying to get everybody through. They're encouraging us to encourage you not to drop classes. And in this 4B, it's not as important as 4A. 4A for accountants, they have to know what debits and credits are and that type of thing. But 4B, I've never worked with this in the real world, and a lot of people don't. So I just want you to stick with me. Let's get us through this class and put it behind us. So anyway, next installment coming up in a couple days, probably moving on to the next chapter. Continue working the homework. If you get stuck on it, please, first thing to do is to look at the corresponding B problem, and then look at the solution to that problem on Canvas and apply the same methodology to your problem. Tutors are still available. They're available online for tutoring. They'll be able to help out as well. And if I can help, by all means, let me know. So anyway, hope you have a great day, and we'll catch up with you on the next video.